Now, one of the things that, as we always start segment 2, you get an idea of kind of where we are on that average basis. And one of the things that we've been saying is that we're going to kind of hug where we were in 21 and 22. And even though gasoline is going to be better than 21 and 22, diesel is going to be much worse. And that's going to be that offset when you look at why we're not back to where we were in 17 through 19. And realistically, it's going to be somewhere in the middle, and that's where you can see the average number just kind of hugging below that 15, closer to about 14.6, 14.5. Like this current week, we had we had demand of 14.26 million barrels a day. Before that was 14.08. That's on the low end. That will start to trend up. So again, that's why it's like we think that 14.6 to 14.7 will be in play. And when you look at 17 through 19, which is easier to see, as well as really 21, you can see that this is when it starts. Like even 22, you start to get that pivot up. And so there's nothing, like as we've been saying, it's going to go higher. It's just going to be below what is normal. And that's something that we think is going to become what I guess you could say is the new normal. When you look at the distillate draw, there was a drop of 1.19 million, but that brings us 15.8 million below the 5-year. But it's important to note that the pad 3 had a build, and it had a build of 500,000 barrels. And that is where we see the most concern in terms of growth of volume in the U.S. because, as we've been saying, we see a big problem with the amount of volume that is coming into the market. And that is where I think they're starting to get a bit of an import side where we're going to start seeing some imports. Now, the European numbers came out today because today is Thursday. The European numbers, there was a build in gas oil of 109. So you're seeing builds accelerate in Europe. You're starting to see builds come up in the U.S. There was an increase in Europe in imports into the U.S. of 51,000 barrels a day. That's 24,000 above the 5-year, and that's the trend that we see. We're seeing more imports, and it's because of that displacement. But our exports are going to be hit. So Pad 3 is going to be a very important region to look at, which is obviously the Gulf of Mexico, because we see a lot of pressure on our exports going forward, which is going to put more product into storage. So typically you start to get that pivot here. We're right at that trough, and we're going to start to see the builds. The question is going to be the rate of change. And our call is that the rate of change is going to accelerate faster. And instead of having that kind of more gradual increase, we think we're going to get a little bit of a sharper move because of that lack of export and because of some of those additional imports coming into the market. But again, nothing ever comes down in a straight line. So we have seen some diesel cracks stabilize a bit. We do see more downside, but it's going to take a little bit of time. There was a nice little reprieve with some cooler weather. We do have some legacy exports that are still there. So again, you see that big drop. Now you kind of stabilize, and then we see that one more drop. And if we get below 20, that's where we think that the U.S. is going to start to see more of those run cuts. And it's important to appreciate what that means, because when I say the U.S. is going to have run cuts, we're not going to ramp and then pull back. We're just not going to get to maximum, those seasonal maximum, which is, let's call it 96, 97% utilization rates. We're going to stop short. We're going to stop at that 94 level, because they're going to look at this and be like, well, there's no reason to ramp up, so we're not going to ramp up. Now, in Asia, they're a little bit different. They will go gung-ho, run things hot, and then pull back hard. The U.S. is a bit more moderate in the way that they use the equipment, which is why it's like, so run cuts for us isn't going to be this big reduction of 3-4%. It's just going to be, we're never going to get to the top, which will equate to 2 to 3%. And that's going to be that difference. Pad 1 still on the low end, but as we start to get into, again, slower trucking, no need for heating oil to the same degree, that's going to put, again, more product. And as those imports continue to kind of wash in, we expect to see those builds accelerate. But Pad 1 is still going to stay lower. And that's going to create, again, a renewed problem for this coming winter, because there's no easy way to get product to close this gap. Because when I show you pad 3, you're like, oh, well, pad 3 should dump into pad 1, no problem. But Colonial only has so much space. So Colonial is going to be max, so you're not going through Colonial. Then the question is, well, but what about imports? Well, it's like it can't come from the U.S. because of the Jones Act. So you're beholden to what the export market shows you, which is going to accelerate. So we will see more coming in, but there's just not as much as historically, because a lot of the stuff that's sitting in the market is Russian, and we are not taking in Russian crude. You could, yes, we're taking it in different ways by it getting imported by the UAE or Kuwait and then re-exported under the Kuwaiti flag or UAE flag instead of the Russian flag. That will happen. But in terms of just, that also increased cost, because you're increasing miles per ton, loading costs, storage costs, all of these things that come along with it. So it's just going to keep things tight in pad 1, even as pad 3 continues to see those builds, which is where, as you can see, we're just above. We're essentially setting a new high for 2023 storage. That is something that we think is going to continue. And you can see the rate of change. Now, again, to be clear, we always start to build in pad 3 this period of time. That I'm not sitting here saying, oh, there's an unseasonal build. No, there's always seasonal build. My point is the rate of change is going to start to accelerate, and that's going to be driven based on the lack of exports. And the demand remaining below the 5-year average and still staying, at that depressed level. We are not saying it's going to collapse. We're saying that we're kind of at a fixed point below that 5-year average that's going to put the pressure. And a lot of that is driven by trucking. You can see it's leveled off. There's not a lot of activity coming. There's a lot of pressure that continues in the market in general. And then when you look at rail traffic, total carloads are up 5.1%, but intermodal's down 10.8%. One of the things we've been saying, grains will be okay. Farm products are going to be strong. Coal is going to be strong. Chems are going to struggle. But vehicle and vehicle parts going to be strong. Petroleum and petroleum products should start to bounce a bit, especially as we talked about some of those movements. But it's going to be costs, because is there any reason to move diesel right now? Probably not. You're coming into the low period. Intermodal is the one that we're looking at the most for the health of the consumer. What are they doing? What are they ordering? If you're not moving stuff intermodal, well, if on rail, you don't really need trucking because there's capacity here. So trucks are going to struggle even further. But if nobody's really buying stuff, which is what we talked about last week on the Econ show, that's where we're going to continue to see some of those pressure points. Then you look at what's coming down the pike on the shipping side, and you can see we're still below the previous year. We're still below the previous week looking out into May, and we don't see that improving. Now, when we start looking at weather's improving. So you're going to, again, that demand for heating oil is going to be gone. In the Northeast, you're going to be slightly above. But again, that's going to be just high 70s, high 60s, low 70s in some points. So just moving into more of a spring fever after a fairly wet and cold April. So then when we look at gasoline, gasoline had a build of 1.74 million, still 14.7 million below the 5-year, but the builds are increasing. And again, it's increasing in pad 3. Pad 3 had a build of 2.28 million. That's 1.5 million over the 5-year. Pad 1 is 1.59 build, but still low versus the 5-year. But the big problem is pad 3. Pad 3 is where we see those builds again, because there's a lot of product out there, and that's where we see these exports slowing down, putting more of that gasoline into the Gulf of Mexico. And then blending components had a build of 1.87, 9.2 million above the 5-year. Again, just kind of in line with where we see gasoline storage. We just see that increasing. Now, again, there's always timing delays with imports. Imports were down 225,000 barrels a day, but that was about right in line with the 5-year. We see that continuing to trend up. You had another build in gasoline in Europe. Like, that's a problem. There's a lot of gasoline in Europe. And as those prices for shipping normalize, this is the natural market. And we're still 9 million below the 5-year. There's more, I'm sorry, 14 million below the 5-year. There's more than enough space in pad 1 to bring in product. There's more than enough. So that arb will maintain open, will be open, and that's where we're going to continue to see that volume coming through. Blending components were kind of right at that 5-year, that 10-year average, but you can see the 10 years skewed by those bottom two lines. So realistically, we're right around where we were in 2022. And as we see some of those pressure points and some of those imports, we do see that trending into the kind of that congestion where you see 2017, 2019, that whole little level that's obviously that pink line, which is 2020, is not going to be obtained, but we're just going to continue to trend a bit higher. And when we look at some of the TomTom data, one of the bigger issues that we had been highlighting is the pressure we expected in Asia Pacific. So you had Eid, you had the end of the Muslim the month-long fast. You had means of which we said that it's going to be important to see how the market reacts and how people react following the end of the holiday. And one of the things that we've been saying is that all of the economic data points are showing problems in Asia. And our view was that gasoline was going to be kind of that last confirmation of, were the problems because of the holiday? Are the problems because of what's happening, going forward? And here you can see that we never got back to the top level. You're coming into the Labor Day holiday, and you're just not seeing a lot of activity. You're about 20% below normal. Europe, again, kind of hugging where they were in 2022. We don't see that adjusting too much. North America trending a bit better. But one of the things that, as you can see, it normally trends up, then starts to come back down. Again, we just going to see kind of that ebb and flow that we've seen previously. Again, seasonal norms staying at the, right now, we'll stay at that higher end of where we've been so far this year, have a small lull, and then have that bounce as we go into Memorial Day weekend. When you look at pricing, pricing has come down a bit, especially on the diesel front. You're starting to see them get a bit closer in relationship. But gasoline, even though there's pressure there, even though there's going to be more volume, you're still fairly expensive for gasoline, which is why as you go into your May and June driving period, gasoline at these prices is not going to entice people. Like, you're not going to see a reason to go out and just drive around when you're paying $3.58 on national average. Again, it'll fluctuate because this is the national average, but you're getting an idea of price is a problem, especially when you look at some of the pressure points that people are experiencing in their everyday lives. Now, coming back to the demand side, you can see that we had that spike, which we typically have during that Easter spring break, and then you get that fairly hard drop. So here we've dropped back down. You can see it's very much at the lower end of that ratio. But one of the things that we've been saying is that it'll start to go up. And you could see on a trending level, it normally kind of starts to grind up. And it's just because you're coming into summer driving, you're getting, people are getting ready. They're doing a bit more on the weekends, going to beaches, parks, or parties, whatever. So the trend will go up. Our point is that the trend is going to go up at a reduced rate, because even at 8.6, you can see that is on the low end over the last 10 years. And we're just going to stay at the lower point of that demand scale. Are we going to go from 8.6 to 9.2, 9.3? Yes, that will absolutely happen. Our call is that we don't get to 9.6, 9.7. Could we spike there and fade? Absolutely. But our whole thing is on the average, we will be below what is deemed historically pre-COVID normal. So then when you start looking at propane, propane had a drop of draw of 600,000 barrels, still well above all the historics, 13.2 million above the 5 years. So again, that keeps us price competitive when you look at what's going into the international markets. And then when you factor in the aspect that the Saudis are cutting production, you're seeing some production cuts out of the Middle East, which that's where they get their LPG. So again, that's also going to reduce LPG availability. And given the storage levels, given the pricing, that's going to keep us competitive going into the global market. Jet fuel, not too much to change in general. Realistically, we had some builds here. When you look at jet fuel demand, being fairly stable, not too much change in that arena. When you look at the 12 weeks ahead, the number of passenger flights scheduled for the 12 weeks ahead is set to increase by 10.4% from the week starting April 25th. Again, all of that is expected based on the increase as you get into, because remember, this is 12 weeks ahead. So May, June, July, you're now kind of peak summer, which is why you see those levels, which is, again, very normal. When you look at passenger throughput, again, U.S. is very stable in terms of right at 2019 levels. Euro area is a bit lower. That's something, as we've said, we think is going to continue. And then global future scheduled flights. You could see that the most recent revisions show a reduction in the number of canceled flights. So you're starting to see some of those levels of April 5th through April 26th, you're starting to see, some of those flights getting canceled. And this is just a very common thing in general. The number of flights scheduled globally in the week of April 25th to May 1st stands at 710,000 flights. And the idea is this will increase by 2.5% over the next 4 weeks as you get that ramp going into summer. But look at the reductions. It was initially supposed to be, 727, then it was 720, then it's now 710. Again, you keep getting some of those flights rolled off, which is why it's important to look at it, and a lot of that is due to being understaffed. TSA passengers, I thought this was a good chart instead of the one I normally show of that 7-day average to kind of take away some of those choppy noise. And it's right in line with 2019. That's something that we had been saying, is that it was going to be fairly stable. There's no real reason to see it go up or down. The thing we have been saying is that it's going to be on the back of less flights. And that, again, continues to play out, which is putting some pressure on underlying jet fuel demand. And then you continue to see pressure in the people who are going out using open table. You're seeing, again, that pressure point where people are just going out less and less, and we think that continues to intensify. So that's what we have for you on the demand side. Again, demand we think is going to be a bit depressed versus historics. It's still going up, just not to the same degree, and that will put pressure on refiners, especially when you look abroad as our exports continue to slow, which we're going to talk about in more detail in the next segment.